So start by setting the expectations. Given what drove markets so far this year, what is going to be what really sets the tone for the rest of the year?
Well, it's so nice to be with you. First off, thanks so much for having me. I think we're at a bit of a crossroads in terms of what happens next. Certainly for markets, it's been such a strong rally really all year long. I mean, we had a blip earlier in the fall where we had a bit of a correction, something that we had been anticipating, but the market seemed to shrug it off and continue to forge a path higher here. And so I think what's interesting at this point is what is the catalyst to kind of keep this market rally going? Certainly, the breather that we're seeing right now is well deserved given the sprint that the market has had all year. But with the Fed sitting on the sidelines and not necessarily taking any policy action, I think it's hard to really grab onto meaningful positive and also meaningful negative catalysts. And so I think what we're left with is a bit of a range bound kind of choppy market from here through year end. So our view is we probably won't see a Santa rally materialize because we already got that turkey rally.
So no Santa Claus rally, but it sounds like you don't see significant downside moving forward. Is this kind of a time for investors to maybe look ahead to what they want their mix to be in their portfolio going into 2024?
Yeah, I don't see a lot of downside at the moment. That's the challenge. I mean, of course, the black swans, you never see coming. So there could certainly be something that catalyzes a downdraft here. But if the Fed kind of stays put right now, we think that, the market kind of chops around and ends up being a little bit directionless. I think the market is really looking to, somewhere in the neighborhood of 100 basis points or more of rate cuts beginning early next year. I would say no way. We're not in the camp that we expect that kind of meaningful policy pivot. But certainly with that kind of sitting there in the near term horizon and markets starting to price for that, it is important for investors to start getting prepared for the new year. It's a little bit of a snoozer though, because we've been in de-risking mode all year, kind of trying to get ready for this highly anticipated recession that hasn't materialized. We still think it will materialize and be mild in nature, but I don't think there's a lot for investors who have already run that playbook to get prepared for. So it's sort of staying the course, staying close to long-term strategic targets, and see what the new year brings.
So Amanda, what's going to be the best indicator of when things are going to shift? I mean, we're looking at the VIX here, currently around early 2020 pre-pandemic levels here. A lot of this risk, at least for the markets, they're pricing it in as being off the table for now. At what point will that turn? What will you be watching for?
I feel like a broken record, but I've been saying this for the better part of the last couple of years, that the single most important driver for markets is when the Fed gets out of the driver's seat. And the Fed has been in the driver's seat for a very long time. And so if we start to get this indication that the Fed is going to take action one way or another, higher or lower, I think that's really when markets are going to start moving and anticipating before we even see Fed policy action. I think in the earlier segment, you were talking about sort of the high volatility nature of Fed speak, right? We've been in a high volatility regime for markets, but the Fed speak has been pretty wide and volatile too. A lot of different views on what the next step is. And so, I think what's really important still is what the policy path forward is. We're in very restrictive conditions, certainly, but we haven't felt the full effects of all of the policy action come through yet. So that's really what we continue to focus on, even though it feels like a broken record story. That's been the case the last couple of years.
Amanda, as you look to position yourself for 2024, where does political risk fall into all this? I mean, certainly the Fed continuing to be the driver in the market, but if you base off of where things stand right now, it looks to be another rematch between the former president and the current president.
Well, I'm not ready to get out my crystal ball forecast yet and determine what, ultimately is going to happen with the outcome of the election. But it's sort of a funny thing when political volatility seems to be a little bit less volatile than what's going on in the market. So it's been fairly calm on that front in terms of market specific implications, though I recognize there's been a ton of political noise this year. We do think that that will pick up certainly as campaign season and election season picks up in 2024. But at the end of the day, what matters the most for the market as it relates to the election is control in Washington. It's not necessarily who's in the White House. It's really who's in the White House, what party's in control there, and also what the makeup of Congress looks like. It's been very narrowly controlled, a lot of division, obviously, currently in the current environment, been very difficult to get a lot done. And so to the extent that we stay in a fairly gridlocked makeup for next year post-election, I think it's really not the story that the market is going to be focused on. If one side wins in a landslide, then it'll be a very different story for markets potentially.
And Amanda, a lot of people vote based on how they feel about their personal economy. But if you look at what we saw with consumer confidence continuing to tick up in November, people continuing to spend despite credit card debt mounting and credit card delinquencies picking up, how are you gauging the consumer? What should we be looking for here?
Well, the consumer has absolutely been the workhorse of this cycle. And I think it's really impressive that the consumer continues to hang in there as well as it is, given how late in the innings we are of this cycle. And so the holiday shopping season for us is a really critical data point in terms of gauging the health of the consumer. Obviously, they're still spending. Questions about, buy now, pay later from an earlier segment. We talked a little bit about that. And so when that bill comes due in January, what does that mean for consumers? But I think consumer balance sheets are still hanging in there pretty well. We're in pretty good shape, but the mix shift in consumer spending, I think, is an important indicator as well. Very much late innings kind of cycle behavior from a consumer spending perspective, but jobs market continues to be solid, wage growth adjusted for inflation still positive. So that's a really supportive backstop for consumers in the current environment.